Thanks for tuning in, Dividend Dashboard here, and welcome to the last portfolio update of 2025. And man, what can I say? It's been a great year overall. In this type of updates, I cover the stocks I bought, dividends received, portfolio value, performance, and much more. So if you want to follow along my investing journey and see future updates moving forward into 2026, all you have to do is subscribe. It's free. And also like this video so like-minded investors like you can find this channel and maybe see a new perspective from a small investor like me. So with no additional fluff, let's dive in. Even though the December purchases were made in small tranches, the focus was never on size, but on quality and consistency. These are world-class businesses with durable competitive advantages, strong balance sheet, and proven histories of compounding shareholder value. Companies like MasterCard and Visa benefit from global payment networks with enormous switching costs. Microsoft continues to dominate enterprise software and cloud infrastructure, and S&P Global operates in an essential data-driven niche that benefits from both scale and regulation. Adding to these positions, even incrementally, reinforces exposure to businesses that are built to perform across economic cycles. A notable shift this month was the higher buy frequency in ADP, where the largest allocation of capital went. This wasn't random, it was intentional. ADP is a quiet, powerful compounder deeply embedded in payroll and human capital management, with recurring revenue, exceptional client retention, and decades of dividend growth. Recently, ADP has dropped in share price, which usually happens when the job data appears to be weak, but the fundamentals of ADP are still compounding. So I found this as a buying opportunity. I even made a video discussing my stance and entry point for a decent return with this business. By buying ADP more aggressively and more often, the focus was on strengthening a core holding that combines stability, pricing power, and long-term dividend reliability. This approach reflects my goal of high-grading the portfolio. During the month of December, the portfolio continued to do exactly what it was designed to do: generate income from high-quality businesses. Dividends came in from a diversified group of companies operating across multiple sectors, reinforcing the idea that this portfolio isn't dependent on a single industry or economic condition to produce cash flow. Each payment, regardless of size, represents a share of real profits generated by durable and well-established enterprises. The companies that pay me a dividend are Visa, $3.59, Kroger, $7.28, Johnson & Johnson, $9.17, S&P Global, $4.18, Microsoft, $2.92, Google, $2.76, Realty Income, $5.91, Hershey's, $20.76, Waste Management, $3.43, and Home Depot, $4.63, for a total amount of $64.63 in dividends for the month of December. What stands out is the quality behind those dividends. These are businesses with strong balance sheet, consistent cash flow, and long history of rewarding shareholders. Many of them operate in industry with high barriers to entry, strong brand recognition, or essential services that remain in demand through different market environments. These combinations allow them to not only pay dividends, but to sustain and grow them over time. Looking at the dividend progression over the years, the trend tells a clear story of consistency, discipline, and compounding at work. What began as a modest stream of income has steadily evolved into a meaningful and reliable payout, reflecting years of deliberate investing decisions and patience. Each December builds on the last, showing that progress doesn't need to be explosive to be powerful, it just needs to be sustained. What's especially encouraging is how the growth has remained strong even as the base has expanded. This points to a portfolio built on quality businesses that not only pay dividends but regularly increases them, combined with the ongoing contributions and reinvestment. Rather than relying on a single year or market condition, the income has grown through a repeatable process that works across different environments. Looking for the portfolio update, the portfolio finished the year with a total value of $33,500, reflecting steady progress built through consistent investing and a clear focus on quality. With a 2.21% weighted yield, the strategy remains centered on sustaining long-term income rather than chasing high-yield opportunities that may compromise durability. This yield translates into $629 in projected annual dividend, a figure that continues to grow as positions are added and dividends are reinvested. During 2025, the portfolio generated $570 in actual dividend income, closely aligned with the forward income projection. This consistency highlights the reliability of the underlying businesses and the strength of the dividend stream being built. Across 21 holdings, the portfolio is well diversified, spreading risk while maintaining exposure to high-quality companies businesses with strong cash flow, competitive advantages, and a history of rewarding shareholders. On the performance side, the portfolio delivered 12.12% return in 2025, compared to the 15.81% return of the S&P 500. While the portfolio underperformed the index, the gap is largely explained by its dividend-focused structure and defensive tilt. Rather than prioritizing maximum upside during a strong market year, the portfolio emphasized stability, income generation, and long-term compounding. When viewed through that lens, the year represents solid progress, both in capital appreciation and in the continued growth of a dependable dividend income stream designed to compound over time. Being honest, I am pleased with the results. I did not beat the market, but bringing a 12% return is not bad at all. I still believe this portfolio will do good over the long term. Now we have my 21 holdings. Going from largest to smallest, we have Google, Hershey's, MasterCard, S&P Global, Visa, Automatic Data Processing, JP Morgan Chase, Microsoft, Texas Instrument, Starbucks, Johnson & Johnson, AbbVie, Kroger, Apple, Realty Income, Pepsi, Waste Management, Nike, Home Depot, Colgate, and Procter & Gamble. The portfolio is intentionally structured around a core group of high conviction positions, with the largest weights concentrated in businesses that combine durable competitive advantages, strong balance sheet, and long-term growth potential. These top holdings are not only leaders within their respective industries, but also companies that benefit from scale, pricing power, and recurring demand. By allocating more capital to these core positions, the portfolio is designed to let its strongest businesses do the heavy lifting over time. As the allocation gradually steps down, the portfolio transitions into a supportive layer of established compounders. These positions still represent high-quality enterprises with proven track record, but they serve a slightly different role, adding diversification, stability, and dependable cash flow. Many of these businesses operate in defensive or essential sectors, helping smooth the performance across different market environments while continuing to contribute dividend growth. The smallest allocations round out the portfolio by providing additional balance and risk management. Rather than being speculative bets, these positions are deliberate exposures to well-run businesses that complement the overall strategy. Together, the structure reflects a disciplined approach, concentrated where conviction is highest, diversified across sectors and business models, and allow quality and consistency to drive long-term compounding without over-reliance on any single holding. Now, do remember, these allocations are not set in stone, and they can change at any time. There's a lot of factors that could change the allocation value of a holding within my portfolio. Looking at the annual income generated across the portfolio, what stands out the most is the breadth and balance of the dividend stream. No single holding is responsible for carrying the income on its own. Instead, dividends are distributed across a wide range of businesses, creating a structure where cash flow is supported by multiple independent sources rather than concentrated risk. The higher paying positions reflects companies with mature cash generative businesses model that are able to return a meaningful portion of earnings to shareholders. These holdings form the backbone of the portfolio's income, providing reliability and consistency year after year. At the same time, the lower contribution positions play an equally important role by offering growth-oriented dividend potential, where payouts may be smaller today but have strong prospects for future increases. This mix reinforces a key principle of the strategy. Income and growth are not mutually exclusive. Some holdings emphasize current income, others emphasize dividend growth, and together they create a resilience and compounding income stream. As dividends are reinvested and positions continue to be built over time, these diversified structures allow annual income to grow organically while remaining supported by high-quality businesses with sustainable payout policies. Moving on, we have the capital invested versus capital gain or loss. This is a graph I created purely for transparency, following the request from viewers in previous updates. It's designed to be simple and easy to interpret. Blue represents the capital invested, while white reflects the current gains or loss for each position. Due to spacing limitations within the chart, not every figure is displayed, but the overall picture remains clear. The visual helps highlight how different holdings are contributing to the portfolio at any given time. You can quickly identify which positions are driving overall performance and which ones are temporarily acting as a drag. More importantly, it provides context beyond just total portfolio returns by showing how capital has been allocated and how that capital is currently working. It's also worth noting that gains and losses fluctuate over time and don't tell the full story on their own. Many positions that appear behind today may still be delivering strong fundamentals, dividend growth, or long-term compounding compounding potential. This graph isn't just about short-term judgment, but about giving a clear, honest view of where the portfolio stands today and how each position fits into the broader long-term strategy. When looking at the total return across the portfolio, the results reflect a wide range of outcomes, which is exactly what you expect from long-term diversified investing approach. Several holdings have delivered exceptional performance, showing how patience and conviction in high-quality businesses can lead to meaningful compounding over time. These strong performers have played a significant role in pushing overall portfolio growth forward. At the same time, there are positions with more modest returns and a few that are currently in negative territory. Rather than being a concern, this highlights the reality that returns are rarely uniform across all holdings at the same time. Different businesses move through cycles at different speeds, influenced by valuation, industry trends, and short-term market sentiment. What matters the most is that the portfolio as a whole benefits from this balance. Strong performance helps offset temporary underperformance elsewhere, while underperforming positions still contribute through dividends, fundamentals, or future recovery potential. This spread of results reinforces the strength of diversified and the importance of staying focused on the long-term process, allowing quality businesses the time they need to deliver value. So that will be it for this portfolio update. 2025 was a great year inside and outside investing. Hope 2026 is a year to set new records. If you made it to this part of this video, thank you so much for supporting. If you have any questions, please drop them in the comment section below. Once again, thank you so much. Happy New Year, and I'll see you in the next one.